I'm going to be cautiously optimistic because of what recent history has showed us.
Hi again, everybody. Welcome back to the Comstock channel. I'm Marlin Bohling with you. Thanks for joining us today. Well, we're going to take a look at Wednesday's market action. Make sure you like these videos, subscribe to the videos by clicking that bell icon, and share these videos with others as well. Well, today, my very special guest happens to be Joe Camp of Comstock Investments. We'll take a look at Wednesday's market action, and it looks like on the grain side, as I kind of run down through the prices here, it looks like wheat was the winner today on Wednesday on the grains. Why would wheat be the winner?
It was up today because it was down yesterday, it seems. It was the weak link of our turnaround Tuesday attempt, and now taking that back. It's a U.S. market that's really following international values, and there's, again, let's not sound like a broken record, but some signs of a rebound in place for those leaders, Russia and France, and their wheat markets. You have also the talk about the maybe peak of harvest pressure in the U.S. being behind us. It's also the case that we're now leaving in the rear view that bearish crop report last Friday. It found that, as expected, but a little bit more than so, yields were proving a lot better than even anticipated coming into the winter harvest, and that's both for the hard red wheat crop and the soft red wheat crop. And it was also the case that the yield potential was raised sharply higher for spring wheat. All of that negativity, maybe it felt like, was priced in on Friday and then during the first couple days of the week, and now we can get past that and at least observe a technical rebound, which is still a lot of what's going on for these grains, is technical positioning.
You know, I'm glad you mentioned that about the wheat. That gives me a chance to do a shameless plug about tomorrow's podcast. Everybody might want to tune in tomorrow because I will be talking with a custom harvester as they work their way up now into the northern plains, and we'll see what they're finding out. Is the crop disappointing, or is it better than expected, or just right in line with average? What do we have up there? We'll get some questions answered tomorrow on this very podcast. Okay, so we'd had a bit of a bounce. I don't know if you can really justify saying that it shows signs of a bottom just yet, given everything that we've had. How much have we taken out of this market now in the last 2 months?
You're talking about a huge slide. If we look at Chicago futures, the more active now December contract has went all the way from a high just ahead of 750 now to very close to 550. So, that's talking about nearly $2 over just a couple of months, 2.5 months. That's a price break any way you look at it. Now, it had been quite the rally as we headed into the months of May. I'd call it April and then May. There was all this talk about problems abroad, and there still are instances of crop issues in the Black Sea or in Eastern Europe. But here in the U.S., that was the big change, is what we just got done talking about, is all of a sudden you had the weather risk premium, not just abroad, but fears over our own crop, and then a lot of relief once we got closer to harvest, whether it was, again, in the Southern Plains or the Midwest. So that's, a fundamental trigger that ultimately sparks probably a technical and speculative snowball like we've observed lately.
Do you happen to have a chart of the wheat that we can take a look at? I guess in my mind, I was looking at some of the recent moves here, and I'm just wondering if we're looking at recent contract lows or just long-term lows. How do you look at that?
Pretty well. Long-term lows, definitely contract lows. I show the Chicago December contract here. If we take a look at the nearby on a continuous basis, I can bring this down to a weekly interval, and we can look at it on a grander scale. We can see the huge spike in 2022 upon the initial invasion of Ukraine, and then the elevator lower in many ways. A couple of spikes here or there, including this most recent one that we spoke of, but now all of a sudden back down towards this really modern base of lows. It's going to be similar with the corn and soybeans as well, which is, if we fall much further, The only thing below the market are lows from 2020 COVID years. And for Chicago wheat futures, we're talking about 450, 460 type lows immediately, down below.
How does this compare to, for example, a corn chart? I don't know if you can pull up a corn chart, but we need to take a look at how much that thing has fallen in recent times here. And now that is not apparently at contract low territory, or at least on a continuation chart. I don't know which one you have here. But
Right.
let's talk about this a little bit.
Yeah, I do have the continuous chart up here for now. We are going to put increasingly more and more focus on the December contract as it becomes more active on a volume and open interest basis. But we do have a couple of key points to keep hold of, including this low from earlier in the year in February, the low from just recently at 390, and beyond that, it's going to stack up, as mentioned, very similar to wheat, because on a broader scale, you don't see below these current lows anything to really catch the market before you'd get down to 2020, which in April of that year marked out a low for the May contract at $3.25. So it was always the risk that if we lose $4, we're going to have a further sell side motivation. But you can see that just glaring here is the fact that it can be the case that these bearish speculators are eyeing $4 to $3. As simple as that.
Well, I am looking at a soybean chart, and if you want to bring a soybean chart up for reference here, you mentioned the performance in the close of the day in soybean oil. That's kind of an ugly looking chart when you look at soybeans, and we're just really not cranking up any export activity on beans at all.
So starting with the technicals of it, you have the November soybean chart here. There was a lot of talk, again, similar to corn, not just about 2020 lows, which are well below $10, but the first conversation was if we drop below 11, it's probably pretty quickly down towards 10, and we've traveled a lot of that way now to settle here today at around 1041. The only very short term hope that we could have here is potentially some oversold type perception entering the market. There's nothing that can absolutely define oversold, but if we match up a couple of different indicators, if we watch for divergence especially, that's something that we could key in on ahead of a potential reversal or at least retracement type of rebound. I look at this November chart and see how sharply we are on a weekly basis below the lower Bollinger Band. Not that many instances over the past 3 years shown on this chart that you get that far down. We can look at it on a daily basis again, maybe more importantly for these momentum and volatility studies. And the one thing we're going to watch for, something I brought up here for the conversation that we had earlier today on a back and forth about natural gas, just this simple relative strength index, how it indexes the average sizes of the up and down moves. We're still seeing that the down moves are coming at a bigger extent than the up moves. So it's going to take a reversal of this and an ending, if you will, or at least a pause in the momentum that is currently squarely lower for this bean board.
Now, okay, when you look at that indicator you have on the bottom of that screen there, I'm guessing that's an RSI table there, or graph. How low is that? I mean, if it's an RSI, generally you consider it oversold below 20, right?
Right, and we're looking at an RSI currently of about 25. So in some ways, that's kind of scary. If folks would say, yeah, it's not oversold technically until we get to 20. And again, I'm going to say it's not oversold until you approach 20, and then you have these other indicators to match, and nothing. That's the disclaimer. No one technical, of course, can be used to say overbought or oversold or ready for reversal. But this is just a real simple one we're going to follow that tells us something about momentum and whether or not we're going to eventually see some easing of the bearishness. And that's the first step. We saw some signs of that here and are thinking about that more and more this week because it fits with the speculative positioning, how they have record net short positions on corn and soybeans, and how you get to a point where you test these really key technical levels. And then they're like, I've said this several times, the short speculator is going to say, well, who's going to join me now? Do they have that much more ammo that they want to add to these positions? Or does it eventually get to a point where they see others covering positions starting to take profit, that the sizes of the move lessen on the downside? The RSI starts to plateau or even move up while prices are still down at the bottom. And that's a type of bearish divergence that some of these funds might use, that their computers certainly might take into account in part. And then they're going to, the discretionary decision of it is to say, I don't want to be the last one out. And that's what we could still expect to potentially spark a bounce, at least of retracement nature.
That's been a big headline for several weeks now about how short the big commodity funds are. How short are they right now? Last you had heard.
Well, record net short, right, in corn and soybeans. So we're talking about well over 350,000 contracts for corn. You're looking at now into the couple of hundreds of thousands of contracts net short on soybeans. It depends how you measure it, futures or futures and options. But this positioning is yes, not something we've ever seen before. And it gets to a point where you wonder about the end of it. It's not a bullish feature to have, again, record net short positions held by the funds, but it can be a signal that you're close to the end if we stop going lower to the same extent that we have been, which is why we're just talking about some of these really simple technical measures like the RSI and using them to look for some signs of potential selling exhaustion.
All right, let me play devil's advocate here for just a moment then. If that's the case, I've heard quite a bit of talk about the fact that farmers have been holding on to so much grain, old crop grain. And if that's the case, in essence, that's like a long position, right? Some say that they are holding much more grain than they normally do. Does that offset the big fund short position in kind of an artificial way?
In part, it does. So you have to approach this from a couple different sides, I believe, this question. It's something I've had conversations about. We talk with farmers about it. We talk amongst each other about how much more the farmer has relative to usual. And it is much more than usual being carried forward from the old crop on a percentage basis. You can see that from those latest grain stocks numbers where we have total stocks up, I believe 22% for corn, yet on-farm stocks up 37% from a year ago. The farmer's hanging on to a much bigger portion of what's left. That can be true. It can also be true that they're not hanging on to quite as much as the USDA says, so that it's more than usual, but it's not that much as, for example, was reported in the last quarterly grain stocks update on June 28th. This goes into the report that we had on Friday for, as a bit of a dud as it was, as a place marker for these more important future reports where we get into acres and yields in a bigger way. The real feature of this report, in my mind, was that, one, the headline that old crop corn stocks dropped back below 2 billion bushels, but the reason why, and that was an addition instead of an expected reduction to the feed and residual usage component. And so that residual is in part an air component that follows from what's left over in the stocks. And it can suggest that that quarterly stocks measurement was too high. And it can be for a combination of reasons. One being that feed usage was a lot larger because it is a feed and residual component. And, that's just a conjecture right now in my mind that actually, for one, feed usage was a lot better than had been anticipated, and that makes it more difficult for these on-farm measurements to be truly captured. It's also can be the case, and it's probably if I had to say yes or no, my determination that the USDA is just generally too high on stocks relative to production, and that unfortunately is another revision that we could still have yet to come. Lower crop sizes that'll be a subject of debate for the September report.
I almost feel like I'm watching a small band at a concert, but do you take requests? Um, I just wondered, you had that chart up a little bit ago. We were talking about soybeans.
Mm-hmm.
You mentioned natural gas, and I had spoken with you earlier today about that. It has an unusual looking pattern to it here. And if you could actually bring that up, you talked about how oversold the
Mm-hmm.
soybeans are. I want to take a look at the natural gas futures and see just what they are doing right now. And is that an opportunity maybe for producers out there? I'm looking ahead toward the drier season, grain drying at harvest time. Is that something that farmers should be really taking a look at? I mean, we're really taking a nosedive in the price right now. Is that something to lock in?
It's something we should be talking about. That's absolutely the case. This is to start a look at where we've been, and the chart here being September natural gas futures. We've got an August contract still approaching expiration, but a couple of weeks out from the delivery period. It's right up against $2. So that's a key support point, which we're testing right now. The September contract here around 208, also approaching a really critical $2 level. It's just a psychologically important mark. It's also a mark that would fit with the leg lower dropping out of a double top here. And usually on a double top, we like to think that the second top is going to fall short of the first one. It did on the nearby August contract when it was the most actively traded contract. So I still think that's in play here, that we can talk about a double top formation. And then what's the extension out of that double top formation? Well, just roughly speaking, simply, you're going to measure the high to low on that first high, and then take that down from this middle low. And we've now done that. We've completed, I think, a 60-cent drop under this previous low. So when that is coinciding with the $2 mark, it's something that really makes us think about whether or not the sell-off is going to be close to ending. What we have to bring up, and why the RSI is here alone, and not with all the other indicators that I'm watching, is just because one of the first things we're going to want to see again is some divergence, where even if price is going down to new lows, there's a plateauing or an eventual lift up for the RSI and other momentum / stochastic studies, which would indicate that the sell-off is easing. And we had a taste of that. We really did. But all of a sudden, a day like this, where you're down 5 or 6% in such a huge move, that's going to take this RSI lower yet again. So it still opens up plenty of downside risk. That's what I want to show here, not only this September chart and how far down we are relative to where we've been over the past several months, over the past several years. We look at just over the last 5 weeks, we're down about a third. We dropped $1 from just over $3 to just over $2 as we're speaking. But one of the many risks that we have here is going to be that the continuous chart lows are going to open us up to an even bigger slide. So if I can type that in here real fast and show you the continuous chart. The continuous chart is going to be all of the nearby contract futures before they go into expiration, and that opens up a more bearish picture even than the September contract alone does. You can see lows from earlier this year at just below $1.50. And that's a similar case, kind of what we were talking about with other commodities here, unfortunately, where beyond that, you have to go back to 2020 and the COVID year to get to a more of a clear bottom and that's 50, 60 cents from here. That said,
Well,
we got to go back to answering the question and say it's got to be a conversation we have. I just want to caveat that once more with the how do you do it, and when do you do it, because we can look at these nearby contracts. We can also talk about if you go out to fall, you're adding premium. It's 220 out to October. It's 320 out to December.
yeah, I think that's something that maybe our viewers out there, if they have some questions about that, maybe they should give you a call and discuss some ways to handle that. I hate to see anybody pass that up in case they need a lot of energy at fall harvest for grain drying and that sort of thing. Maybe there's some stuff that you could do, maybe at least to maybe do some risk management, to protect it from going much higher at harvest time when the demand kicks in. Just wanted to point that out. Well, let's take a look at livestock then here on a Wednesday, and switching over to the livestock table. Cattle market a little higher, feeders generally kind of a little weaker. The hogs gained some on the intermediate months. So let's talk about that. It wasn't a runaway train by any stretch, but was it a positive day or not?
It was a positive day for the price action being down early and then up at the close, pretty considerably for some of these live cattle contracts. You have a test back into the middle of the range. Some of these 20-day moving averages. We'll stick with the chart theme. Overall, though, the fundamental debate is still pretty much back and forth, a lot like it was a year ago. This is something I keep bringing up. I think it's topical. The fact that we got past the 4th of July holiday and there was a bit of a lull, or at least an expected lull in beef demand. And we saw that weigh on beef prices. They broke late in June, went down for most of the month of July. But what did futures do? They paused. They really didn't go that much lower. And in fact, they were just waiting for what would eventually be that rally up to new all-time highs later in the summer. And so, that's the back and forth of it here, is to recognize, we could have some seasonal negativity develop here because of the time of the year, but it's also still a fundamentally bullish market because of tight fed cattle supplies and still relatively solid demand on a consumer basis. The next test of a lot of this, the supply side in particular, is going to come next Friday, or coming up already, the cattle on feed report again.
If you look at the hog market activity there with triple-digit gains, are you optimistic that maybe they have made a turn now or not?
I'm going to be cautiously optimistic because of what recent history has showed us about even you make these so-called bullish outside days and then have very little follow through, that you have some semblance of fundamental strength in the cash market, and then all of a sudden a give back of that really rather quickly. I will say that I think we're closer to a bigger turnaround because of what we'd expect to be lower prices being the cure for lower prices, and finally generating some better demand. And that can be a conversation about the grains, or it can be the hogs after such a sharp slide. And it fits with the hedge funds having turned net short in the hogs and now coming to a point where they want to take some profit along with what they see to be a better demand generated. And that's not just for domestic demand, which we think holds up well, especially in the face of still resilient, we'd call it beef prices, but also on export demand, which is much more important for the pork.
Other than the grain and the livestock and the natural gas, anything really catch your attention here on a Wednesday?
Well, we can tie in with the natural gas, even though they were going in opposite directions. The oil market moved. Crude oil up almost $2 a barrel for most of the session. You've got a weekly domestic production report showing numbers down by more than anticipated. We're pretty positive about how the summer driving season is going for fuel demand. That can be linked back to the grains, of course, with some processing strength ahead, potentially if crude oil stays strong to boost those biofuel margins. But you've got that crude oil as a harbinger of all of the global security risk and all of the repositioning that goes along with Iran and them and that country popping up in the news related to, in part, President Trump and the upcoming elections and what would potentially change for domestic energy policy. We're, as always, going to have to watch these outside financial markets, but the oil can be a leader, either higher or lower, for the rest of the commodity space, and the grains are definitely attached to that.
Well, thanks for covering all the ground that you did here today, and we really did, looking at Wednesday's trade. I encourage everybody to get in touch with you if they got some questions about the markets. That's Joe Camp. He's with Comstock Investments, and that'll do it for this episode. Thanks again for joining us, and we appreciate your support as we continue to grow this channel. Make sure you share this video with others as we build our audience. For producer Brianne Hendrickson, I'm Marlin Bohling. We'll catch you next time on the Comstock channel. Thanks for joining us on our Comstock YouTube channel. Don't forget you can also find us on Facebook and TikTok as well. Futures trading involves risk. The risk of loss in trading futures and or options is substantial, and each investor and or trader must consider whether this is a suitable investment. Past performance is not indicative of future results.